Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 103rd podcast and 113th videocast for the week ending Thursday, December 16th, 2021. We'll kick it off with media, and then we'll get right down to it. We've got quite a bit to cover today and a lot of great stuff. So first off, I would like to thank Liz Klayman, Stu Oppenheim, and Melanie Kapadia for having me on the Klayman Countdown on Monday. We'll go into this one here. Covered a couple of picks that we liked and that have taken off since. BristolMyers, they announced a $15 billion addition to their buyback authorization on Monday. The stock was up a few percent that day. It's followed through nicely. And the entire group has really been down on the basis of the Build Back Better program has some proposed drug pricing rules that would require companies to negotiate prices with Medicare on some of the most expensive drugs. It's unclear whether that's going to pass. It looks like that's not going to pass before Christmas, as was the goal of the Democratic Party. And if Manchin and Sinema don't want to change the rules, it may not pass at all. But more likely, some watered-down version will pass in the new year, and I believe that it will be less prohibitive. Even if it's not, the bad news is priced in. Bristol-Myers is trading at 7.5 times next year's earnings, which is half its historic PE multiple of 16 times average over the last decade. Their Eliquis blood thinner is still growing, and other new drugs like Abecma for multiple myeloma and Reblozyl for anemia hold promise for future growth. The other defensive stock I covered was Becton Dickinson, which does medical supplies and devices. They're going to grow earnings at 10% next year and beyond, trading at below market multiple at 18.4 times next year's earnings, 1.42% dividend yield while you wait, higher than the 10-year at the moment. But the difference is, unlike the 10-year, you have meaningful upside on this defensive stock as they continue to compound earnings. Margins are expanding, and we see their non-COVID business picking up materially as more procedures and in-person visits are resuming and will continue to do so in 2022. As it relates to the overall market, Liz asked me, what would you be doing the last couple of weeks of the year to prepare for 2022, and I shared that generally the play to do historically has been to buy the laggards of this year, which could become the leaders of next year. And in the short term, some of the stocks that have been a little weaker going into the Fed meeting yesterday were energy and financials, but they've done quite well this year. So you could add some of them like Citi, etc. But the group that we're really focused on is industrials. They're expected to grow at 36.2% next year. Earnings growth relative to the S&P, which is below 9%, and that's not priced in. They're not trading that way. So a few that we like Lockheed Martin. They have just recently increased their buyback $5 billion. They're trading at 13 times earnings. They've reduced their share count, by the way. Their buyback has just been consistent. They've reduced their share count by 1/3 in the last 16 years. They increased their dividend by 7.7%, I think, to 54 cents this quarter, if I'm not mistaken. Other industrials like Boeing, we've talked a lot about that recertification with China. They did the flight authorization plan a week or so ago, which was very positive. Many analysts took their price targets up to 270 plus. We saw more of that this week. They've and also the recertification, the items that they outlined a week ago are expected to be met before the end of the year, which would be a positive catalyst. And then another industrial that no one's paying attention to right now is GE. With the breakup, the sum of the parts is greater than the whole. Larry Culp is one of the greatest CEOs in history coming out of Danaher. So those are some groups that we like to focus on in that context. So again, thanks to Liz and company for having me on Monday. Moving along to Cheddar, we're going to cover a lot of this later in the article because it's salient as it relates to the Fed meeting and the announcement. But I want to thank Kristen Scholler, Ali Thompson, and Joe Cole for having me on. Moving along, was quoted in Reuters twice this week. Want to thank Devik Jain and Sriyashi Sanyal, as well as this was Reuters. I believe it was, I'll get that name in just a second. Thank you for having me on that. That was just pre-Fed issues. And also, why was the market up when the PMI came in hot? Slightly above expectations. And that was markets up because the numbers were pretty much in line with expectations as it relates to the CPI. That was Friday, and did not dramatically exceed as feared. A lot of people thought those CPI numbers were going to, go through the roof. They didn't. The markets pretty much accepted the fact the Fed will likely accelerate tapering to end in March versus originally in June. So that was that. And then I thought this was interesting. But before I go into this, this article was out today. I really liked it. It was by Barbara Kohlmeyer over at MarketWatch. And Barbara's great. She featured me in a couple of her articles over the last year. But she's covering a Citibank note that came out today. And what they're pointing to is what I talked about on Liz's show, which is that the last shall become first. The laggards of last year were the leaders of this year. If you remember, the 2020 performance for Wells Fargo was negative 44%. This year was up 62%. So that was our big trade last year. Energy stocks like BP down 46% last year, up 33% this year. ExxonMobil was another trade, negative 41% last year when we were buying, plus 49% this year. Boeing, this is interesting, was down 34% last year. It was also down 9% this year. We think this is going to be a home run in 2022 and probably early 2022. So they show how it's worked in the past. They also show that the best stocks didn't perform terribly well. If you look at Zoom, was up 396% last year, was down 46% this year. And some of the Chinese stocks. Now, the key of this article is they say, okay, so that was last year. What do we think is going to outperform this year based on their performance? And the number one stock that they're saying for contrarian bulls is Alibaba. And I think we're going to see another Wells Fargo where it was down mid-40s for the year, and it's going to wind up being up huge in 2022. We'll talk a lot about that. SoftBank, AT&T, by the way, got upgraded today. That one might be interesting, down 22% on the year. That could have some performance, maybe as the 5G gets cleared. For the airlines were some issues, as well as the Warner play, which we'll cover, the Discovery play, which we'll cover in an analyst note here in a second. Tencent we like as well, and Walt Disney down 18% this year could be a huge play. And then what are the best performers that they think could underperform next year? Moderna, NVIDIA, Applied Materials, and that type of stuff. So I really like this article. I think it was phenomenal, and I think it's going to be right. And that's historically how we've played it. And I think some of these names, Baba a couple months early, I don't expect any miracles from Baba in the next 2 weeks. I think there are going to be a lot of managers that want it off their books for year end. They don't want to show it to their clients that they had it on their books in the last month or so, or some of them had it much earlier than that. But I think in January, you're going to see a ton of money start to just pour into that group in a material way. So we like that, and we'll use any weakness. If we can top up, we'll top up. This is another interesting article from Nicholas Jasinski over at Barron's. He lists the S&P 500 sector's cheapest stocks, Communication service, again, AT&T comes up at 7.3 times. We like that. Discovery, 7.5, 7.7 times. We like that. The home builders are still cheap. Pulte Homes, I put out an article this week about millennials buying is not going to stop anytime soon. We've been talking about that for months. Lennar, we like. Altria is interesting, 9.3 times. Walgreens Boots, we still love here, 9.9 times next year's earnings. Molson Coors TAP, we like, 11.1 times. Some of the energy stocks, you got to be a little bit more selective in the energy stocks, not taking the ones that have run up too much, but taking the ones that have meaningful upside. He put some insurance companies here. Viatris, this is in context of the whole drug complex, which we've been talking about. We just talked about Bristol-Myers. We talked about Becton Dickinson, which is supplies, not pharma. We've talked in recent weeks about how some of the biotech stocks look like they're in a depression. I think they're going to start to see the light of day in a material way next year. So they actually have Bristol-Myers on their list. Organon, which was a spin-off of Pfizer. Viatris is the generic producer. We like that one. Perrigo is another one, beaten to death. Teva is another one as they settle their lawsuits. We've been seeing a lot of option flow come into that. The airlines, Delta came out today with just strong numbers, much better than anyone expected. I think that whole group's going to fly. The other thing is you're seeing the positivity rate in South Africa on Omicron already rolling over. So we'll keep an eye on that, but that's really good news as it relates to this travel stock. But I think the biggest catalyst is going to be when they come out having approved the Pfizer pill, the name will come to me in a bit, which works against Omicron. That is you're gonna just see when that gets approved, because if you recall, we covered a few weeks ago, the government's already bought, I think, 500,000 doses in the U.S., if not more. It was $5.9 billion worth of. So anyway, it was maybe it was a million. But it was a lot to get started and go from there. What else do they have here? They've got they've got Mosaic, some chemical companies. They've got a few REITs and then some utilities. So they should have some more industrials. So industrials, they've got Cummins. That's okay. Delta, I like. Alaska Airlines, I like. That's more transports, but anyway, you get the point. This was a great article. You can check that out at Barron's. Then J.P. Morgan, Marko Kolanovic, one of the few sell-side guys I really like. There's a handful. Unveils his 20 global ideas for investors to maximize their returns in 2022. He's always worth a read. He also said that, he added that the key themes for the year include higher oil prices, more mobility, fewer supply chain disruptions, better conditions in emerging markets, especially China, and higher interest rates with a steeper yield curve. He also said that travel, leisure, and experiences theme has an extremely attractive risk reward. To that, he adds, we expect outperformance of cyclical assets and value, recovery of riskier and more volatile assets, and headwinds for defensive bond proxies and market segments that benefited from the pandemic. So in the U.S., we retain a pro-cyclical tilt. He's got 7% upside, target of 50-50. So he's conservative, but he likes reflation-sensitive sectors like energy and financials, consumer services, healthcare, and small caps. He cautioned there were enormous valuation gaps between low volatility stocks and value stocks, between expensive stocks and cheap stocks. If valuations start to revert to anything like normal levels, value stocks and cheap stocks will presumably outperform. We agree. We agree tremendously with that. Emerging markets, he says. He says had about double the upside. Emerging markets have about double the upside of U.S. equities because of the improving earnings and their steep discounts today. He forecasts an 18% return for MSCI Emerging Markets Index. Better EM sentiment from current lows, stronger earnings growth, convergence of historical relative valuations should lead emerging markets to outperformance versus developed markets. At the country level, we prefer China number 1, Indonesia, Russia, and Brazil. We recommend pro-risk allocation in our emerging markets equities model, above trend global GDP growth, real interest rates close to zero, vaccination/reopening, and higher than historical ERP for EM relative to developed markets. Along the way, he upgraded China, Saudi Arabia, and energy stocks to overweight, while downgrading South Africa, Taiwan, and industrials emerging markets. Along with his overweight on Brazil, he suggested a risk-on barbell of consumer discretionary and value stocks in this context, which means materials, energy, and banks. And that's that. So great note out there. Disney got upgraded by KeyBank, Brandon Nispel. Overweight target of $216. Stock remains significantly undervalued. KeyBank analyst sees over 40% upside. We agree with that for 2022. Goldman's out talking about the 3 aerospace and defense stocks may be the best offense in 2022. They start with Boeing. I think they've got $260 price target, so they're still on the... Oh, no, I'm sorry. Goldman upgraded it with a Goldman Sachs price objective for Boeing is $305. That's more in line with what we're looking for. Consensus target is lower at $260. Then they also have Raytheon and I think Textron. But the key is the theme. Boeing on track to double aircraft deliveries in 2021. The key is going to be the recertification to see the 2022 orders, and we expect to get that before the end of the year, according to management. Now, moving on to buybacks hit record after pulling back in 2020. So there's over $1 trillion of buyback authorizations in the market right now. That's going to represent some support moving forward in 2022. The trend is expected to continue as companies top $234 billion in third quarter repurchases. That tops the previous record of 223 in 2018 fourth quarter. The wave of repurchases has helped propel the U.S. indices to dozens of records in 2021. More buybacks are coming. Howard Silverblatt, he's over at S&P. He's very good. He projects the buybacks will reach $236 billion in the fourth quarter, which would be another record. And he just goes through that. So he shows how they plunge. This is interesting. If you remember, Ben asked the question, why do companies buy when they should be selling and sell when they should be buying? In March, when all the bargains were on sale, and I was on Fox with Liz saying, Wall Street's the only place when they hold a clearance sale, no one shows up. The companies wouldn't touch their own stock. And now that they're up 100, 150%, they can't get enough. And that's just the name of the game. They point to Lockheed Martin here. Lockheed is underperformed, which is why I like the fact that they're buying back. Their stock is tremendously inexpensive here, and we think that's going to be an opportunity. And then you got on Monday, BristolMyers adds the $15 billion. If you recall, we were talking about the pharma stocks like Merck, BristolMyers, AstraZeneca, I think we mentioned last week, and Novartis. Was one of the Ask Me Anything questions. We said we love them all here for 2022, and they've already started to take off this week, which was nice. Novartis is up finally after just sitting there for a while. It's up to almost 6% today. They've decided that they're going to use up to $15 billion of the $20 billion it earned from selling Roche Holding for a massive share buyback. I think that's probably the best use of capital. It's a tremendously cheap stock, and we continue to like that. Now, on to the general market. Here's why stocks are likely to jump. 80% likely to jump again next year. Okay. Good years for stocks are followed by even more gains 80% of the time. Investors might assume following a 20% plus gain, gravity will set in, but reality tells a different story. The S&P 500 jumped 10.4% on average in the year following a gain of 20% or more, says Sam Stovall, strategist at CFRA, looking at data since World War II. And more importantly, S&P rose 80% of the time in the year following such a big gain. 10.4% might seem disappointing following the S&P's recent showing. But that's right in line with what we've been saying. Our expectations have been for high single digits to low double digits for 2022, with a lot more volatility as the market starts to sniff out reduce liquidity reduction by the second half of next year. And I think that is the crux of this article. Yeah, so that's good news. The other thing is, this is from Ann Schrader's over at Fortune. Even when the Fed starts hiking rates, stocks could keep rising for 10 months, according to Deutsche Bank. And they just go through the average returns following the first rate hike. And since 1955, Deutsche Bank analyzed 13 separate hiking cycles. The trend is solid growth in the first year of the hiking cycle, with an average return of 7.7% after 365 days. So they haven't even started tightening yet. My guess is the first rate rise will come in the summer of next year. Maybe it'll come sooner, but I think it'll be in the summer. So then you look at 12 years out, 12 months out rather. So you're talking mid 2023, which would make sense, because I think looking at the dot plots, and we're going to cover that, if they follow through with what they're anticipating, they could invert the curve by mid 2023, and that would probably lead to some type of mild recession in 2024. We'll see. Maybe they won't make the mistakes of moving too fast. But anyway, it bodes positive for now, and that's what matters. This is the next 12 months. This was a note from Zero Hedge. I'll get the source in just a minute, but it shows 12 months after the first rate hike, what tends to outperform. Small caps, okay? So that's the Russell, 15.8%. Then you got energy, financials and healthcare do fine. Telecom and utilities also have double-digit gains. And then value exceeds growth. Value 13.6 median versus growth at 4.9. The source of this data, I think, is Nomura. Yeah, it's from Nomura, and you can find it on Zero Hedge. What's the Fed's hiking cycle market? What the Fed's hiking cycle market backtest shows. That's a mouthful. Okay, Ryan Dietrich over at LPL put out these charts, which I thought were interesting. This is the average return of the S&P 500 from over the past 70 years. When you're up 20% through November, what does December look like? And it looks like a lot of volatility the first 15 days of the month, and then you tend to trend higher through year end. And we'll see if that follows through. Looks like tech is taking it on the chin a little bit today, but that's what we anticipated in the article we wrote last night, when everyone got excited about tech after the Fed was really hawkish yesterday. It was a little surprising to me. So we're seeing more of what we expect, which is companies that are earning cash flow today are getting rewarded in the market today. Banks are up, industrials are up, some drug stocks are up, but the NASDAQ is down 2.33%. The Dow is just up about 40 points right now. Okay, the year two of the presidential cycle is the weakest. So on average, it's up 66%. It's up 6%. So that's, again, that's in line with our subdued returns, high single digits to low double digits next year. And then beware the calendar isn't doing anyone any favors the next quarter. So year two, Q1 is so-so. Q2 gets choppy on average. Q2 of next year in the presidential cycle over the last 70 years tends to be a negative quarter, so that would be Q2 of next year. We expect volatility in Q1 or Q2. I think we're finally going to get a 10% plus correction, and that'll be an opportunity. Now, we talked about the dollar in recent podcasts and videocasts, and I showed the commitment of traders and the commercial hedgers. Usually when they start getting short, I want to follow along with them. They tend to be early, and then it rolls over. Commercials have been getting short the dollar, and that's why I said a couple weeks ago right around here that, if I look 6 to 9 months out, I'd probably say the dollar's lower, which was non-consensus given the fact, the Fed is going into a tightening cycle, et cetera, et cetera, et cetera. And this could push higher before it moderates, but there was such a consensus that this was going to push, back to 100 on the Dixie. And I just don't see that playing out with the commercials this short. I think certainly the gains are going to slow, and if not, we're going to see some weakness in the next 6 months. And this is an interesting headline. Investors are the most bullish on the dollar since 2015, says BOA. This is another indicator that we might be ready for some weakness. When one side of the boat gets too crowded, you want to start to look at the other side of the trade. That's coming from one of their surveys. Now, the cash glut in Eurozone drives the dollar demand. This was in the Wall Street Journal, I think yesterday. A wave of programs intended to boost European bank loans has left institutions looking for a place to park cash heading into year end. And that's also given the dollar probably more strength than it's due in the short term. Cash-rich Eurozone banks are rushing to change their euros into dollars by the end of the year, driving a key measure of demand for the greenback. The interest rates on the 3-month euro cross-currency basis swaps, in which one party borrows a currency and lends their own in return, have turned more negative in recent weeks. This means traders in Europe are paying a premium to exchange excess euros for dollars. That's driving the demand. Artificially, the steeper cost in part reflects a wave of programs initiated by the European Central Bank. Analysts and investors say intended to boost lending to households and businesses during the economic recovery from COVID-19. The programs have saddled Eurozone banks with more cash than they want, prompting it to seek ways to get rid of it. There's so much money and not enough investments to be made. They've opted to trade their euros for dollars and then put that cash into the Federal Reserve's reverse repo facility, which allows banks to park cash for a return of 5 basis points. Nearly 1.6 trillion flowed into the Fed's reverse repo facility on Monday. Near the record, money into the facility has hit repeated highs this year after the Fed boosted the return to 5 basis points from 0%. The facility is made even more attractive when compared to the short-dated European government debt, which often comes with negative yields, meaning banks would lose money on holding them to maturity. The yield on the benchmark for the 2-year German government bond stood at minus 69 basis points on Monday. So while the Fed facility and additional bill issuance may sponge up some excess dollars, they won't reduce the amount of euros when traders swap currencies. Ownership changes, but the amounts are unaffected. Let's see. Here we go. Analysts expect euro to dollar funding costs could diminish after the new year. The anticipated beginning of the Fed's tapering, in which it will reduce its pace of bond purchases, is expected to increase the supply of short-term debt known as bills in the market, giving investors additional places to park excess dollars. A potential raising of the debt ceiling, the government's borrowing limit, would also allow for more debt issuance, increasing supply in the market. So this might be a short-term phenomenon, and that's what the commercials are sniffing out. They think this is going to, they're betting that this ascent of the dollar is going to recede sometime soon, and we like that viewpoint. We agree with that viewpoint. Okay, so we covered that. How is Omicron affecting air travel? So far, it's not. We saw Delta's numbers were phenomenal today. You're seeing just a little bit here in December, but on balance, it's still holding up pretty good, and I think the market can look through that. Moving on to Asia, here's an analyst, Heng Kun Hao, head of market strategy at UOB, says the move will have little impact on Asian markets, the Fed taper, that is. Hang added, Asia's strong trade fundamentals are likely to help countries in the region weather the winding down of Fed bond purchases. Asia in general, so far, all the central banks are very well prepared. FX reserves are at a record high. This view of the Fed tightening has been well communicated. We should be able to handle a bit more of the so-called outflow of hot capital when the Fed does start hiking. Heng Kun Hao said, head of market strategy UOB, told CNBC's Squawk Buck Asia on Monday. Asia is on strong footing for trade, and that, in a sense, is guided by China as well. Our economic models are all export-driven, and that helps a strong environment, reinforces the local currency stability. ASEAN countries stand out It is one of the few areas in the planet where 2020 growth rate is still going to be higher than 2021. Now moving on to China. The beauty of China's slowing in the property market is now, and going into the China National Congress, which we spent a lot of time on last week, is that now all guns are blazing for the Chinese government to step up their fiscal and monetary policy, and now they're doing it. And they're changing their tone from tightening, hawkish, regulatory to easing, getting things, bringing things back from the brink with all these property defaults. So China's latest challenge is engineering a soft landing for a sputtering economy. China shifts back to emphasizing economic stability. Chinese leaders pledge to keep growth stable after government policies to rein in risks have triggered a sharp economic slowdown. Whoops. We've been talking about that. We started talking about that in January when they were tightening while everyone was still loosening. We said this is too soon. They're going to have to reverse course mid-year. They did their first reserve requirement ratio reduction in July. They just did a surprise one last week of 50 basis points, and another 100 to 150 are coming. And that's going to continue. We're going to see more fiscal stimulus and complete about face. Just like Powell just did his pivot, we're going to see the Chinese government. Powell pivoted to tightening. The Chinese government is now pivoting to loosening quickly and aggressively. China adds new incentives for banks to lend to small businesses. That came out this morning. Step up support for small businesses, unveiling new financial incentives for local banks to lend to those companies, according to a state council meeting chaired by Premier Li Keqiang on Wednesday. Okay, so that's that. The new scheme will run from the start of 2022 through June 2023. Moving along, Wall Street gets increasingly bullish on China. Goldman strategists join JP Morgan in bullish call on China. MSCI China Index now down 21% this year on tech real estate woes. China's battered stocks present a buying opportunity as most of the headwinds facing the country's economy are now priced in, according to Goldman Sachs. Although risks around Chinese growth outlook remain due to the zero-tolerance COVID policies and regulatory tightening, Chinese equity markets already reflect some of those risks, offer attractive valuations, and continue to be underinvested. Goldman Sachs strategists led by Christian Muller Glissman wrote in a note dated on Monday, their overweight call echoes that of JP Morgan strategists who upgraded China stocks this week, saying they expect a major rebound in offshore Chinese equities next year. You're paying roughly a bottom third multiple relative to history, so that feels like quite a good entry point. We couldn't agree more, and we spent a lot of time on that last week. Sinovac study spurs bets on further China policy easing. So apparently their vaccine doesn't work against Omicron, and with their zero tolerance policy and shutdowns, they're going to have to put forth a lot of fiscal and monetary stimulus to offset it in the short term, even if it's only for a few weeks, like hopefully is the case in South Africa. If that positivity rate is already starting to roll over, that's a good thing. And it gets the Chinese government moving more quickly than they would have otherwise with the stimulus, and that helps all the positions we've been talking about. China's economic slump fuels calls for more stimulus. Investment growth slows, retail sales weaken after outbreaks. People's Bank of China keeps interest rate on a one-year loan unchanged. That's going to change very soon. And it started with the reserve requirement ratio, and we'll probably see that in coming weeks. China's seen adding fiscal stimulus after setting 2022 targets. Key economic meeting retains tough language on property sector, long-term fiscal boosts limited by local government's debt curbs. Economists predict China will start adding fiscal stimulus in early 2022 after the country's top officials said their key goals for the coming year include counteracting growth pressures and stabilizing the economy. Curbs on the property industry are expected to remain, while there could be fewer regulatory surprises compared with the sudden moves in 2021 to rein in sectors from technology to education and entertainment, the economist said. At the end of their three-day meeting, the communists said that on Friday, the top priority for next year is ensuring stability. They also vowed to front-load policies and keep the monetary stance flexible and appropriate. So these things are all coming to pass. We're checking off the boxes, and then opinion will start to follow trend. I think as we get through the end of the year and managers can start buying these stocks, they're going to start to move, and then you're going to see a whole raft. These headlines are going to change very, very quickly, and you're going to see a lot of positivity. China's economy needs more help. So, this is clear around the world. More help is coming. China's bubble bursting has Wall Street eyeing a 2022 rally. The nation's shares lag global peers by the most since 1998. JP Morgan predicts Chinese stocks will rise almost 40%. I haven't even seen that yet. I read this article. I missed that. So JP Morgan predicts Chinese stocks will rise almost 40%. We've been talking about that 30% range from the Goldman note a couple weeks ago, and we said that, but that's the index. What that means is they're going to be individual stocks up 30, 50, 100+% if the general indices are rising 30 or even 40% as JP Morgan thinks. So that's a huge opportunity, and we think that's the best value right now. Another article out of the South China Morning Post: Huawei and Tencent lose cloud market share as Alibaba, Baidu extend their lead, report shows. China's cloud infrastructure services market saw third quarter revenue grow by 43% year on year to $7.2 billion. The demand for cloud computing accelerated after the COVID-19 pandemic forced activities like work, shopping, entertainment to migrate online. For those of you who know the Amazon story, the cloud financed the entire business. Everyone thinks of Amazon as a retailer. The whole game was the AWS that provided the margins to finance everything, to get Prime started, and everything else. And Alibaba is a beast. So Alibaba Cloud led the mainland China market with 38.3% share, up from 33.8% in the second quarter. While the number 4 player Baidu AI Cloud held 8.2% of the market compared to 7.8% the previous period. Alibaba grew 33%, driven by internet, financial services, and retail sectors. So that is the core growth story. And Alibaba's Ali Cloud is growing faster than AWS at this moment. It's going to be a giant. People are not focused on it, but as the stock starts to go back up, more analysts will start to focus on it. And remember, opinion follows trend. We've been saying that for 2 years since we've been doing this podcast. When we were first talking about banks and energy, for those of you who have been with me for some time, said, pessimism couldn't be greater. But once these stocks bounce, you're going to see opinion follow trend. And then all of a sudden, after they were up double, everyone wanted banks, everyone wanted energy. You're going to see the same thing with Chinese stocks in 2022, in our view. So, again, opinion, not advice. Go to hedgefundtips.com, click on terms. Okay, so another one, South China Morning Post. Alibaba, Tencent, and Chinese tech stocks are good values with policy conditions priced in. Lombard Odier says it's a Swiss fund manager sees values in Chinese beaten down tech firms on optimistic outlook on online advertising revenue. Swiss firms, high conviction funds in China and Asia count Alibaba and Tencent among their top 10 holdings. And they just go on pretty much laying out the same case that we've made in the last few weeks. AT&T, if you remember, it was on the Boeing cheap list. On the Barron's cheap list that we went over earlier in this podcast. Just got upgraded by Morgan Stanley to overweight amid the Discover Media merger. So what is the price target they put on this? I think it was high $28 a share. But they push it to overweight. They'll take that price target up once it starts to move. So you're seeing these laggards start to get interest into year end. It's a little bit dicey, but I think as the calendar rolls over, you're going to see a sea change, if not before. This was the Delta numbers we talk about. Forecast profit ahead as travel demand and fares rise despite Omicron. So that's also good for Boeing as well as the airlines which we own. European Central Bank cuts pandemic bond buying but pledges further stimulus. What they basically said was, we're not the Fed. If the Fed starts raising, don't expect us to raise anytime soon. So you got the BOJ and you got the ECB that are highly accommodative, even if the Fed starts to tighten in line with their dot plot. Campbell's Soup is finally getting a bid. I think it was up 10% this week, so that took a little while, but now it's on its way. Like all great investing, it just takes patience. Omicron symptoms could seem like a cold, but don't underestimate this variant, experts warn. Spoke to a contact in London last week, and he said that the people getting it seems to come on quickly and also die pretty quickly. And the reason they're saying don't underestimate it, is basically you get a runny nose, a headache, fatigue, sneezing, or sore throat, and you may think it's just a cold, and then you go out and spread it. That's why they're saying don't underestimate. We're not seeing the hospitalization numbers for the most part rise, and certainly not the death rate rising. So it seems like it's extremely contagious and relatively mild, and that's a good news. And if it's like South Africa, maybe that positivity rate will roll over in a matter of weeks, and that would also be a very positive thing. So we'll see how that happens. A couple of great charts out from Carl Quintanilla over at CNBC. If you don't follow him on Twitter, you may want to do so. He's a hardworking guy, and he puts out a lot of good stuff. He forwarded this. Today's flash PMI data indicate that supply constraints in the major developed economies appear to have peaked and are now at the lowest since March. Although still high by historical standards, this alleviation of supply delays, if continues, bodes well for future inflation. We've been talking about that. We talked about the ships at the LA port last week, and that's why we think, this over-aggressiveness to move so fast is fighting yesterday's battle. We do think the supply chain issues are going to ease up, pretty quickly, and we're seeing evidence of that across industries. But also, as we've covered many times, the commodities basket, whether it's grains, metals, some energy, hogs, they all started rolling over in recent months. That will take another 3 or 5 months to show up for the consumer, but it is happening. And so you don't want to get too tight too quickly, and then you've got inflation coming down at the same time. So they need to take it relatively slow. Taper's one thing. The key will be whether they make a mistake going too aggressively with rates too quickly. This is big news. Carl put this out this afternoon. Pfizer's COVID pill allowed for use in Europe before regulatory nod. That is a big deal, and be interesting to see how quickly the U.S. gets on board with that, and we'll talk about that in the article of the week. The other thing Morgan Stanley came out with, lower income households, nominal wage growth has leapt over inflation, which is good to see. Yes, their goods are going up, but their wages are going up faster. Inflation receding in 2022 should support a strong consumer outlook and the buying power for lower income households. And it said basically the less you earn, the better you did on this recent inflation in terms of your wages went up far faster than inflation. So that was nice to see. Goldman put out a note today. The probability of the Build Back Better becomes law at all looks lower. That said, the enactment of some version of the Build Back Better still seems slightly more likely than not. That's from Jan Hatzius over at Goldman. And he says, build back later, build back better, build back later, or build back never. So we'll see which of those three it turns out to be. New York City just reported the highest weekly occupancy level, 81.5 of any U.S. market. New York City tourism is picking up despite COVID. Very good to see. I think people, this Omicron thing, I think people are just over it. They're like, most people just get the booster and they don't have to worry about it. But even if they don't, if they've had it or whatever, they're just saying, I'm going about my life. If I get it, I'll deal with it. And that's that. This was what I was referring to with the defense group, the Senate. So the House and Senate passed the $768 billion defense spending bill that went to Biden. That'll probably be signed. It passed 88-11 in the Senate. And the $768 billion is, I think it's up. Let's see. It's bigger than it was expected. I think $715 billion was requested. So that'll bode well for the defense sector, industrials, etc., which has been our theme. Art Cashion, Wall Street legend, UBS, came out with some predictions today. I thought some of them were very interesting to take note of. Interest rates, he expects they'll not be as high as everyone assumes. The headline a year from now will be that rates don't rise as much as people assume. I hope that's correct. I think it will be. Surprise on inflation, not what you think. Inflation will indeed prove to be transitory just when the Fed has given up on the word. I agree. I think we actually probably hit our peak inflation numbers this week with the PPI and the CPI. COVID likely to become manageable. That's because we'll have more therapeutics. Key to stocks and economy is the consumer. And he's expecting like post World War II baby boom. They're going to go out and spend. People talking about the roaring 20s. We may in fact get it again. That would be nice. That's been our base case since last year. Major boost to stocks is buybacks. We just covered that. Tech valuations will moderate. We agree. Earnings, analysts underestimating growth. We've been making that case. It's still stuck at 220, 272. It's ticking up every week, but we haven't hit the 230 yet. He's thinking that earnings growth could be 15 to 20% next year. I'm not that optimistic. I think it's right now at 8.7. I think it could definitely jump up to 15% for sure. But that's we really don't need that much more to get the high single digits to low double digits that we're looking at. He thinks that the Chinese government, because their slowing economy, is going to start a geopolitical mess to distract from the bad economy. I disagree. I don't think they want a geopolitical mess ahead of the China National Congress. I think they're going to juice the economy very quickly and very aggressively, and they're starting to do so already. And they want to go into that transition from a position of strength, not a position of disorder and chaos. And that's that. So those are, pretty good. Inflation break-evens, as we covered a couple weeks ago, have already come down. They hit a high in mid-November of 317 5 years out. Now they're back in the mid-twos. 2.66, which is above trend growth. I think that's a great place to be. 2.5%, I think it would be very positive after a decade of slow growth and basically deflation to have above trend inflation to get people to take action versus never have to buy anything because they know, a year from now the price will be the same. So I think, 2% is fine. I think, 225, 250 for the next 5 years would be very constructive. It shows demand. You don't want to get, much over that, but, you don't want to tighten that too quickly. The Bank of America Global Fund Manager Survey came out this week. There's a lot of good data here. What you did see is they are starting to move into emerging markets, but they're also moving into a lot of defensive stuff, which now they've had to start to unwind. The other issue, we're going to talk about that. Biggest tail risk were central banks getting too hawkish on rate hikes, inflation, and COVID resurgence. And the most crowded trade was still long tech stocks and long Bitcoin, followed by long ESG. Now, the article of the week is the autopilot disabled stock market and sentiment results. Chair Powell did a fine job threading the needle at his press conference following the FOMC announcement yesterday. He achieved his feat by signaling flexibility at his press conference. Quote, the Fed is prepared to adjust the pace of purchases if warranted by changes in the economic outlook. In response to a question during the press conference, Chair Powell responded. So on the first part of your question, which is why not stop purchasing now, I would just say this. We've learned that where in dealing with balance sheet issues, we've learned that it's best to take a careful sort of methodical approach to make adjustments. Markets can be sensitive to it. This is the most important line. And we thought that this was a doubling of the speed. We're basically 2 meetings away from finishing the taper. And we thought that was the appropriate way to go. So we announced it, and that's what will happen. My comments. This acknowledgement of markets implies that the Powell put is still in service for the time being. He's telling you that we're cognizant of markets and we don't want to rock markets. This is in sharp contrast to what he did in December 2018 when his statement was, quote, so we thought carefully about this on how to normalize policy and came to the view that we would effectively have the balance sheet run off on automatic pilot, meaning we'll just keep flooring it until the car crashes. That statement created the worst December stock market performance since the Great Depression. It was a complete disaster. Secretary Mnuchin had to step in, call all the banks on Christmas Eve, backstop the markets, and turn things around. And then in January, he did an about-face, different kind of Powell pivot. So he learned from his mistakes, and that's what we all do, and that's positive to see. But I do think his language yesterday was a bit hawkish, and I hope he'll come off of that as the data starts to moderate in coming months by the time the taper is over. The two most important statements of the FOMC release: with inflation having exceeded 2% for some time, the committee expects it will be appropriate to maintain this target range, meaning the Fed funds rate, at zero until labor market conditions have reached levels consistent with the committee's assessment of maximum employment. In the press conference, he defined maximum employment as a discretionary measure that encompasses unemployment rate, labor force participation rate, job openings, and demographics. But if you look at their economic outlook, they see unemployment at 3.5% this year. So my guess is they want to match that pre-pandemic number in February of 2020 of 3.5% and get those 1.2 million more unemployed people back to work. And that's what they're modeling in their economic projections. So you could read into it that, where is that? Until labor market conditions have reached levels consistent with the committee's assessment of maximum employment. The committee is assessing 3.5%. So perhaps they'll be smart about delaying the rate hikes until they get closer to that level, which would be more likely the summertime than when the taper ends in March. And then they doubled the taper as was anticipated. In theory, leaving short rates low for now and reducing longer dated treasury purchases to zero by March should re-steepen the curve in coming months. However, we did see a big change in the dot plot from the September meeting. As you can see below, rate hike expectations among FOMC members jumped from 1 to 3 for 2022. This is the September dot plot, September 22nd. You can see they were all down here at 1 rate hike. And now December, they've jumped from here to here, from here to here, which is 3 rate hikes or 90 basis points. This is a big change. And at this pace, they could easily invert the curve by 2023 with the recession starting in 2024. The question will be demand from foreign buyers as the Fed steps out of the market. He referenced the foreign carry trade in response to the following question related to the steepness of the curve. The question was, which is what I would have asked, I want to ask you about the bond markets. When you see the 10-year yield at 146 basis points, do you have any sort of concerns about an environment by which you might be hiking rates into? Would you prefer the curve to be a bit steeper? What are you gleaning from the bond market actions over the last 6 weeks? Chair Powell, I think a lot of things go into, by the way, this is word for word transcript, the long rates. And the place I would start is just look at global sovereign yields around the world. Look at JGBs, look at Bunds. They're so much lower. You can get, a much higher yield on U.S. Treasuries by buying U.S. Treasuries rather than Bunds, and you can hedge the currency risk back to yen, back into euros, and still be way ahead. So in a way, it's not surprising that there's lots of demand for U.S. sovereigns in a world, at a risk-free world where there's so much, they're yielding so much more than Bunds or JGBs, so that's a big part of it. My comments. What is consistent is the idea that the Fed would continue to raise rates aggressively what is inconsistent is the idea that the Fed would continue to raise rates as aggressively as the dot plot implies if they see inflation collapsing back to 2.3% by 2023. And that's their base case. So CPI inflation and core CPI inflation dropping off to 2.3%. So by 2023. So it goes to the old saying, don't listen to what people say, watch what they do. Furthermore, why is the rush to remove accommodation so aggressive when they see GDP collapsing back to 2.2% in 2023? So hopefully they'll ease up. So the market faced its fear yesterday and became a sell the rumor, buy the news phenomenon. Now the question becomes, is the first move the right move? This was prescient, by the way. The first move was a move into tech, and today we're seeing that was not the right move. Will the yield curve continue to flatten as the Fed removes $80 billion a month in Treasury bond purchases, also 40 of mortgage-backed securities by March? I.e., will the manufactured demand for the long end of the curve that is going away be displaced by foreign demand? If so, the move to tech yesterday was correct. A flatter yield curve and slower growth environment would favor businesses with long duration earnings that can grow in a weak economic environment. Or will the yield curve start to re-steepen in coming months? The red line above turns back up. That's the 210 spread. Away from inversion. If it went down to 1, that would be inversion and we'd get a recession. We think it's going to reverse back up as the Fed exits as a buyer of the long end of the curve. If that is the case, you want to be in small cap, cyclicals, value, and reopening trades, which was also supported by the Nomura table that we told you what happens 12 months out after the first rate hike. We favor this outlook, the re-steepening of the curve, and think coming sessions will start to move in this direction. Today, you're seeing exactly that, with financials and energy at the top of the sector performance list, as well as pharma, by the way, which is pretty interesting, which we talked about on Monday. So if foreign demand displaces the Fed purchases, as Chair Powell posited in the conference, and 171 was the peak in the 10-year yield for this cycle, as was the case when they announced taper in December 2013. We've shown this chart quite a bit in the last few weeks. We will invert the curve sooner than expected, assuming the dot plot is accurate. I think we may press above the recent peak in yields as the Fed steps out of the market, but we will see in coming months. If true, it would extend the cycle as banks have more incentive to extend credit with a steeper curve. So we really want to see the 10-year yield press a little bit above this peak, I guess 176, 1.76 earlier this year, and then it got up to like 1.71 a month or so ago. Of note, we're still waiting on the approval of Pfizer's Paxlovid, which would recharge the reopening stocks overnight. Pfizer's Paxlovid COVID pill showed near 90% efficacy in preventing hospitalizations and death in high-risk patients, and recent lab data suggests the drug retains its effectiveness against the fast-spreading Omicron variant of the coronavirus. Pfizer Chief Scientific Officer Michael Dolston said in an interview just yesterday that he expects authorization for the use in high-risk individuals from the U.S. FDA and other regulatory agencies soon. He does not believe an FDA advisory panel meeting will be needed. We are in very advanced regulatory dialogues with both Europe and the UK and have dialogues with most of the major regulatory agencies globally. That approval will be a big deal. By the way, for those of you listening to the podcast, you're going to get cut off in 3 minutes. Just go to hedgefundtips.com, scroll down, click on the VideoCast. It's a YouTube video. Fast forward to minute 60, and you will pick up word for word exactly where you got cut off, and you can watch the rest. And if you want to rewind and see some of the pictures and tables from the rest of the podcast, you'll be able to do so at that time as well. So we covered the Fox Business appearance, and I want to go through the Cheddar appearance, which was on Tuesday with Kristen Scholler. We talked about meme stocks and high multiple / price to sales stocks. They wanted to bring me on to discuss those. Ali called me around lunchtime and asked if I could come on at 3 to discuss the meme stocks because they were down in the morning, then they bounced. And I said that they're correcting. AMC was down basically about 70% peaked from the June peak till now. First off, they were overvalued to start with. So AMC and GameStop. AMC traded up to 5 times its 2019 valuation, and the box office is still a fraction of what it was pre-pandemic. The Wall Street Bets crowd finally got the message when CEO Adam Aron sold most of his stock in the last month for $35 million. Retail was left holding the bag as the stock has now fallen at almost 70% from its June peak. Of note, Adam Aron saved the company. So, he is a great CEO who played a very tough hand to perfection, and he's the reason the company will survive despite industry headwinds. He sold stock when he could and raised a lot of capital for the company, and this is a completely different conversation than valuation, okay? I think he's a great leader, but I think, the company got to a ridiculous valuation that was unjustified by any metric. High multiple price to sales, tech, momentum stocks, meme stocks, and crypto have been selling off ahead of the Fed announcement tomorrow. This was done on Tuesday. While it's widely expected they will accelerate the taper from $15 billion a month reduction to $30 billion a month, which is what happened. The big issue is whether that will mean rate hikes start sooner as well. This will have a big impact on high multiple meme and crypto stocks. So right now the dot plot says 3. These stocks should not be doing well. And sure enough, what do you see? Now tech is down almost 3%. That's what should be happening. And you're still seeing banks and energy up despite the market being down pretty big. This will have a big, okay. So why will this have a big impact on high multiple meme and crypto stocks? Right now, the cost to carry crazy is 0. We covered that last week. I think Brian Kelly from JP Morgan was on the Claim and Countdown. That was his saying. I thought it was great. In every cycle, when capital is mispriced, cheap / low interest rate, it leads to malinvestment. In the late 90s, it was the dot-com boom that turned into a bust. Mid-2000s, it was housing speculation. And today, it may be to some extent these meme stocks, the high price to sales multiple, and crypto speculation, particularly certain parts of crypto speculation for sure, i.e. SHIT coins, etc. But I heard a statistic that something like 90% of crypto is on margin. So as the margin rates go up, this is going to have to be unwound, and we'll talk about that in a little bit. But with the exception of the last decade, over the past 100 years, buying a basket of stocks trading at 10 times sales has inevitably led to massive losses. In the past decade, because rates have been at record lows and the recovery was slow, high multiple names were bid up as managers crowded into the few areas they could find growth in a 2% or sub 2% GDP environment. Rate hike expectations. If you look at the Fed dot plot, they're expecting 2 rate hikes in 2022. Now that's moved up to 3. And the Fed fund futures were telling the right story, which we're seeing 3 rate hikes, and that proved to be true yesterday. This is critically important because when rates go up, it makes the value of long duration earnings assets, companies trading at high price to sales multiples on the promise of earnings and cash flow far out in the future, they go down when rates go up. These companies have the companies that have current earnings and cash flow become more valuable as investors demand earnings and cash flow today when capital starts to cost them something. When capital costs something, you want your capital return now. When capital is free, you say, oh, mañana is fine. You're going to change the world. We'll give you a runway. But once the capital, once the meter's ticking for you, the investor, you're going to demand that they return capital today, dividends, buybacks, and generating cash flow. So you will also see the speculative assets come down when rates rise because the cost for paying for margin goes up, leading many to take down their leverage ratios. We believe the stocks that have driven the market, FANG plus NVIDIA and Tesla, will start to underperform or perform more in line with the S&P 500. Those stocks that have been left behind, like value, small cap, and cyclicals, will outperform. We're seeing that today. Despite Omicron, we expect the Fed to accelerate the taper tomorrow. However, we also expect them to signal that hikes will not necessarily begin immediately after taper stops. They did that to a lesser extent, but the implication was, based on the dot plot, they were open to starting right away. So it was hawkish. It was hawkish yesterday, and you're seeing it today. They'll look at the data. Commodities have been weakening in recent months, grains, metals, energy, hogs, but will not be felt by the consumer for another few months. The supply chain is also improving as we are seeing ship count moderate at the LA ports. Industrials is a sector we're focused on in 2022. The sector is expected to grow earnings at 36.2% relative to the S&P 500, which is expected to grow earnings at 8.7%. The last shall be first. We think laggard companies like Boeing, Lockheed Martin, and even GE can start to outperform next year as the climate changes. The BOA survey we already covered. The 3 key takeaways were managers rushed into cash in the past month and will now have to chase up once again. In addition to cash, they also moved into defensive positions ahead of the Fed meeting. And the biggest tail risk is hawkish central bank rate hikes. We're seeing that impact on tech today. China, this is the most important chart, I think, of probably the year. As we mentioned on last week's podcast, VideoCast, we've swapped out our U.S. Alibaba shares to Hong Kong 9988 shares. You get eight shares of the Hong Kong for every one of the U.S., but you get the same intrinsic ownership value. While likely unnecessary, it takes any delisting risk off the table for us. We can always switch back. In that context, we saw this chart posted by David Ingles of Bloomberg TV earlier this week, and this is brilliant. As you can see in the charts above and below, match the trough years, it is paid handsomely to be a buyer of Hong Kong stocks when they traded below book value. That is what they're doing right now. So while we're trading at 21 or 22 times forward earnings in the U.S., they are trading at below book value. I think we're trading at 3 times book in the U.S. And if you look at these years, every single time it traded below book in the last 25, 30 years has been a huge opportunity to buy. So let's look. Last year, boom, we had that huge rally where Baba got up to $310. Then you had back here in 2016 was one of the biggest runs here until the 2018 regulatory crackdown. Then you had the 2009 monster opportunity, 2003 monster was the biggest rally in emerging markets in history. Then you had 1997. 1998 LTCM monster rally over the next 2 years. So this is a great opportunity. I think it's going to set up well for 2022. This is also consistent with the emerging markets. China's 35% weight, the biggest weight in the indices, to U.S. ratio that we've been showing in recent weeks to illustrate the extreme that we expect will begin reversion in 2022. So emerging market stocks are plunged to a 20-year low versus U.S. equities in relative valuation. We're betting this is going to revert, and these are going to start to outperform as people look for value. Why? Because capital starts to have a cost. When capital costs you something, you demand returns, and not promises for returns at some nebulous point in the future. Retail optimism was wiped out as of last night, down to 25% bullish. That bodes well for the end of the year. Fear and greed was at 34. That's also, there's fear in the market. And then this is the active investment managers was 70%, which means they're underweight. But we got the latest read this afternoon. It's down to 53%. So if this market turns after this short-term choppiness from the Fed, we're going to see a massive chase for that Santa Claus rally of the last week and a half of the year, as there are only a 55% exposure to equities. Okay, so finally, market participants were happy with that the market went up after the Fed announcement, but make no mistake. Despite Powell's now experienced hand at the press conference, it was a hawkish outcome, and we're seeing that today with embedded flexibility to assuage the market, which happened yesterday. In that vein, our outlook for 2022 remains intact. High single-digit to low double-digit returns for the S&P in 2022 with much more volatility as participants sniff out liquidity withdrawal by the second half. We will continue to be focused on buying those areas of high quality that are on sale or even trading below book value. And trading at reasonable valuations, as we referenced at the end of our Cheddar interview above, which is worth a watch if you have 6 minutes. The last shall be first. The opportunities to make big money will be under the surface in 2022 as capital starts to have a cost. Buying companies that generate earnings and cash flow today will be rewarded. Some economic data from this week to wrap up. Here we go. Building permits were up. Continuing jobless claims came in less than expected. That was a good number. That's very important. Housing starts were up. That's this week. Okay. That's all today. Housing starts better than expected. Initial jobless claims came in a little higher than expected, so that's not great, but we'll keep an eye on that. And the manufacturing PMI came in less than expected, but is still in expansion at 57.8. Services PMI came in a little less than expected at 57.5, but still in expansion, expected to be 58.5. So keeping an eye on those. And crude had a big draw of 4.5 million barrels compared to 2 million barrels expected. Demand is still there. New York State Empire manufacturing was better than expected. Core retail sales came in light last week. I think a lot of that was pulled forward because people were afraid of the supply chain, so we got it before last month. And then the PPI numbers came in hotter than expected, and the Fed knee-jerk responded to that with a super hawkish meeting yesterday. So earnings estimates are still at 221.71. They're slowly ticking up every week, but I'm with Art Cashion. I think like this year, where they came in at basically double the growth that analysts had expected. I think we're going to see probably mid-teens growth versus 9%, and that'll be enough to get the high teens to low double-digit returns. So with that said, I want to thank everyone for listening in. We went through a lot of great information. Hope you found it helpful. We'll be back next week, same time, same place. Make it a great one.